The Bush tax cuts will run out by January 1st unless Congress votes to extend them. That vote is slated to take place in a lame duck session after the midterm elections. Republicans want to make all the cuts permanent. President Obama and many Democrats want to continue the cuts in marginal tax rates for so-called middle-class taxpayers and let them lapse for individuals with incomes over $200,000 and families with incomes over $250,000. The president says letting the tax cuts on wealthier Americans expire would reduce the budget deficit by $700 billion over the next 10 years. Republicans say such a move would be dangerous during such a shaky recovery. So I took an in-depth look at the tax cuts in a recent column. I tried really hard to let the facts shape my opinions, not vice versa. The bottom line, I could find no evidence that the Bush tax cuts successfully stimulated the economy apart from other more powerful factors. I could find no economist who can measure their effect precisely. Also, the economic recovery of the 2000s was the weakest since World War II, and those tax cuts were very expensive. At least $1 trillion in borrowed money so far, and $3 trillion more over the next decade if they're made permanent. Because of their spotty results at best and high price tag, these tax cuts must be judged a failure. The 2 rounds of tax cuts slashed marginal tax rates, changed estate tax laws, and cut taxes on capital gains and dividends. After the second round of cuts passed in 2003, GDP growth picked up considerably. But crediting the Bush tax cuts with even most of the gains from the last economic recovery is like saying Scottie Pippen led the Chicago Bulls to 6 world championships in the 1990s. The Michael Jordan on this team was, of course, Federal Reserve Chairman Greenspan, although his legacy has soured. He cut interest rates from 3.5% to a mere 1% in July 2003, just in time for the second round of the Bush tax cuts to go into effect. Those rock-bottom rates coincided with the blowout phase of the biggest housing bubble in U.S. history, which most economists agree was the main driver of economic growth in that period. Housing-related industries may have been responsible for 40% of the new jobs created during that era. And even if the Bush tax cuts produced half of the economic growth and employment growth that occurred, it was half of a pretty small pie. 8.3 million jobs were added from August 2003 to December 2007, versus 22.7 million during the Clinton-era recovery and 16 million during the Reagan rebound of the 1980s. That means the economy got little bang for the buck from those cuts. So, what do we do now? Let these tax cuts expire? Economist Mark Zandi estimates that letting them lapse for top earners would reduce real GDP by 0.4% in 2011 and by 0.2% in 2012. But he thinks letting them all expire would precipitate a double-dip recession during the first half of 2011. Given the state of the economy, I think that would be too risky. That's why I'm in the admittedly inconsistent position that favors keeping all the failed Bush tax cuts through 2012, then phasing them out over the next 5 years. By then, the economy should be much improved, and we can start to address our mammoth debt problems in earnest. I would let dividend tax rates go up to 20%, but cut capital gains taxes in many instances to provide incentives for employment growth. Anybody who's sincere about dealing with the deficit will have to put all these tax cuts on the table, along with domestic and military spending, and of course, entitlement programs like Social Security, Medicare, and Medicaid. Politicians who continue to dance around this, be they Democrat or Republican, are just wasting our time and mortgaging our future yet again. This is Howard Gold for the MoneyShow.com Video Network.